What's up everyone and welcome back to the channel. Today is December 18th, 2025. Are you feeling the fear today? The Fear and Greed Index has plummeted to 22, extreme fear. Bitcoin and equities are dumping in tandem and there's blood in the streets. On-chain data shows that after several days of inflows, exchanges are finally seeing net outflows today. It looks like everyone is running for the exits. But, just as retail is capitulating and panic selling, our monitoring systems have picked up on something massive. Mysterious whales are stepping in around the $85,000 level with their jaws wide open, aggressively absorbing all the sell-side liquidity. So, is this a continuation of the downtrend, or is this the final shakeout before the next leg up? Today, I'm going to use the Wyckoff method, combined with macro analysis and 9 dimensions of data, to give you a deep dive and reveal the truth behind this battle between the bulls and the bears. Make sure you stick around to the end, because I'll be giving you a very specific trading setup based on the MACD and ATR indicators. Data and evidence. Alright, let's start with the macro picture and market sentiment. This is the weather that dictates the market's overall direction. First, sentiment. As I mentioned, the index is at 22, extreme fear. Why so much fear? Because the macro environment is genuinely concerning. The Fed's interest rate policy is still up in the air, threatening volatility at any moment. At the same time, regulatory headwinds from both the US and China are intensifying. Whether it's crackdowns on mining or new SEC investigations, it's like a sword of Damocles hanging over the market, suppressing any upside potential. This bearish sentiment is directly reflected on-chain, with exchanges flipping to net outflow, which tells us that even the confidence of Web3 natives is starting to waver. Second, let's look at the technical trend. This is the market's map. Please look at this weekly chart. The price is currently testing a crucial support level, the long-term trend line around $86,000. More importantly, look at this yellow line, the 20-week moving average. It has already started to slope downwards. This is a critical signal, suggesting the market might be shifting from its previous wide-range consolidation into a new downtrend. Meanwhile, the 60 and 120-week MAs are converging, indicating long-term price compression. A major directional move is likely imminent. If we get a clean break below $86,000, followed by a retest and rejection, then the next long-term support level to watch is down around $76,000. Seeing this, you might be thinking, it's over, the bear market is here. But hold on. Let's look at our third piece of data, the MACD indicator. Despite this bearish macro picture, if you look at the daily chart, the slope of the MACD has been ticking up for 3 consecutive days. This suggests that beneath the surface, a force is building, attempting to engineer a short-term relief rally. But, and this is important, this bounce is starting from a deep negative territory, which means bearish pressure remains dominant. To turn this ship around, it needs to be backed by significant volume. And where is that volume going to come from? All signs point to the whales. This brings us to the core of our analysis today, the Wyckoff method. The current market structure perfectly aligns with the characteristics of the final stages of a Wyckoff accumulation phase. The market manufactures fear to shake out the weak hands, forcing them to give up their coins, while the strong hands, the whales, quietly absorb their supply at these lower prices. How can we prove this? Let's look at our fourth and fifth dimensions of evidence, on-chain flows and order flow. First, fund flows. We're seeing net outflows from exchanges, meaning Web3 natives are de-risking. But at the exact same time, Bitcoin ETFs, which represent TradFi and Wall Street money, are showing slight net inflows. What does this tell us? It tells us that institutions are not panic selling like retail, they're structurally rebalancing and adding to their positions at a discount.
Now for the most dramatic piece of evidence, order flow data. This is the market-wide liquidity heat map. As you can see, the book is thin. There's a severe lack of deep order clusters, meaning most participants are sitting on the sidelines. But look at this large order tracking chart, and it tells a completely different story. At $86,500, $85,000, and even down to $84,000, we are seeing extremely dense clusters of whale bids. What are they doing? They're building successive lines of defense, soaking up every single coin being panic sold into the market. Simultaneously, we see massive sell walls stacked above $90,000. This is the bear's defensive line and a formidable resistance for any short-term rally. So, the picture is crystal clear. This is a macro-induced retail capitulation event, where whales are strategically accumulating at key support levels. The contracting volume across the market gives these whales the opportunity to move the price with relatively less capital. Strategy and conclusion. Decisive tone, giving clear recommendations. Okay, putting all this information together, let's form our final conclusion and trading strategy. The current market is a battle between a bearish macro outlook and bullish micro-level whale accumulation. The long-term trend is testing downside support, but in the short term, the whales have a strong incentive to engineer a relief rally to capture arbitrage. Therefore, I have two distinct strategies. First, for short-term traders. The opportunity here is to trade with the whales. Our ATR indicator shows that the price is currently at the lower band of its volatility range. Combined with the whale bid locations, the $84,500 to $85,000 range is a potential long entry zone. The target is clear, the massive whale sell wall sitting at $90,000. But, I must stress, this is a knife catch, and the risk is extremely high. You are fading the macro trend. Therefore, use light position sizing, absolutely no leverage, and set a tight stop loss. A break below $84,000 should be an immediate exit. Second, for mid to long-term investors, my advice is to stay cautious and remain on the sidelines. The macro pressure has not been lifted, and the long-term trend remains under threat. If the whale's line of defense, this $85,000 to $86,000 support zone, is ultimately breached, the market could experience a much deeper leg down. In that scenario, our midterm target can be the weekly support level we discussed earlier, around the $75,000 mark. Outro. Summarize, call to action. To sum it up, today's market is a tale of two worlds. You have the ice-cold headwinds from the macroeconomy and regulation, and you have the fire of accumulation being stoked by whales in the depths below. The market's next direction will be decided by the outcome of this battle, and the key battleground is $85,000. As smart investors, we don't need to predict the future. We just need to read the data and follow the signals. Understand who is selling and who is buying. That's how you navigate through the fog and make the right decisions. Alright, that's all for today's analysis. If you found this content helpful, please make sure to hit that like button, subscribe, and turn on notifications so you don't miss our next update on market structure and whale activity. Let me know what you think in the comments below. Are we going to break out above $90,000, or are we going to break down below $85,000? Let's discuss. Thanks for watching, and I'll see you in the next video.